Thank you for joining our Getting Ready for ASC 606, What Your Company Needs to Know webinar. So I'd like to present to everyone today Mr. Chris Rabin. He is Partner and Director of Quality Assurance at Sikich. He's going to take the lead here in the first half of our presentation. And then we have William, but we like to call him Billy Tamulinas. He is our Senior NetSuite Consultant here at Sikich. Quick introduction of our agenda. We'll go over with Chris the ASC 606, need for adoption plan, key requirements for private companies, and timeliness for the adoption process. Then Billy will take it away with our NetSuite tools, features of that NetSuite revenue management tool to help handle this transition. Okay, Chris, I'm going to send that presenter status your way. You can take it from here.
Okay, thanks, Michael. Hi, everybody. My name is Chris Rabin. I'm the partner in charge of quality assurance for the firm, and today I'm going to introduce you to the new guidance on the accounting and reporting for revenue, including where it may be found, why the change, what are the new requirements, how these requirements differ from existing GAAP, when it is effective, and how you might begin to implement it. I'm also going to point you to additional resources that are available if you want more information, including an implementation tool that we developed here at Sikich. Now, in terms of where the new guidance is, if you look at your top left, the hint is right there. It's in the Accounting Standards Codification number 606. I won't get too bogged down with the details there, but just for you to know, the old revenue guidance was in section 605, and all the new guidance is in section 606 of the FASB Accounting Standards Codification. Now, for many entities, revenue is the single largest amount in their financial statements. Management, lenders, shareholders, and other financial statement users focus on revenue to monitor an entity's financial performance and general financial health. Trends in revenue from period to period are also important. Revenue is used in many financial ratios, debt covenants, and as a basis for determining certain employee compensation and benefits and stock-based compensation awards. Now, in the late 2000s, the FASB and the International Accounting Standards Board undertook a project to try to converge portions of U.S. GAAP and international financial reporting standards and selected revenues as one area to pursue. Both the boards had identified weaknesses in their existing accounting guidance for revenue, and both also recognized their existing disclosure requirements were not adequate to provide financial statement users with sufficient information to understand an entity's revenue. The objectives of the project were: 1, to create a more robust framework for addressing revenue issues; 2, to simplify financial statement preparation; 3, to improve comparability across entities, industries, jurisdictions, and capital markets; and 4, to remove the weaknesses and inconsistencies; and 5, to improve the usefulness of financial statements through enhanced disclosures. So current GAAP utilized more of a rules-based approach to revenue recognition so that revenue could be recognized if certain rules were met. However, the new guidance uses a principles-based approach that often requires you to apply more judgment when considering certain matters such as contract terms and other facts and circumstances. While Topic 606 attempts to address the accounting for various contract terms it's found across multiple industries, it does not address every fact pattern that may be present in specific industries. Those industries will now need to interpret and apply this principles-based guidance to their transactions. There are 2 key principles to be applied when accounting for revenue. 1, revenue should be recognized in a way that reflects the transfer of promised goods or services to customers. Thus, determining when a promised good or service is transferred to a customer is a critical factor. 2, the amount of revenue recognized should equal the consideration an entity expects to be entitled to for those promised goods or services. Determining the consideration in many transactions is not difficult because the amount is fixed and will not change. However, in other transactions where variable consideration may be involved, or if there are multiple goods or services to be delivered, that determination can be much more difficult and require judgment. The new guidance applies to all entities regardless of industry that enter into contracts to provide goods or services to their customers in the ordinary course of business, unless applicable guidance is included in other accounting standards. It also includes contracts to transfer certain non-financial assets such as real estate or equipment. Now, the following contracts with customers are specifically excluded from the scope of this new standard: lease contracts, insurance contracts, financial instruments covered by other literature, guarantees except for product and service warranties, and non-monetary exchanges between organizations in the same line of business to facilitate sales to customers. The revenue recognition guidance includes a 5-step approach to serve as a guideline to help you adhere to its key principles. We will explore each of these steps in a little more detail in the following slides, but here are the 5 steps. Step 1 is to identify customer contracts. A contract is defined as an agreement between at least 2 parties that creates rights and obligations that are enforceable. Step 2 is to identify performance obligations, which are promises in a contract to transfer distinct goods or services to a customer. Step 3 is to determine the transaction price, which is what you expect to be entitled for providing the goods or services to the customer. Step 4 is to allocate the transaction price to the performance obligation. If there's only one performance allocation, the allocation is pretty easy. Step 5 is to recognize revenue when or as performance obligations are satisfied. So let's look at step 1. On step 1, we have to start with the basics, so we first have to identify the customer. The customer is the party that contracted with the entity to obtain goods or services from that entity. Most of the time, identifying the customer will be easier. However, in some situations, such as multiple party arrangements or collaborative arrangements, identifying the customer can require a little bit more judgment. Next, you have to identify the contract. There are at least 2 key words in the definition of a contract. The first is agreement, and while that might imply a written agreement, that is not required. It can be written or verbal or an arrangement implied by your customary business practices. The second term is enforceable, and the new guidance states that enforceability is a matter of law. As a result, you'll need to consider federal, state, and local laws to determine whether a contract is enforceable. After you identify the customer contracts, you then have to identify the performance obligations. A performance obligation is a promise in a contract with a customer to transfer distinct goods or services to that customer. The concept is similar to the concept of a deliverable in prior revenue standards. In a basic transaction at a hardware store, the hardware store's performance obligation is to provide the goods such as a hammer that the customer decides to purchase. In a service industry, the performance obligation may be a one-time obligation such as preparing a tax return, or it may be a continued service such as providing lawn services on a weekly basis from April through September. A good or service is considered to be distinct if both of the following are true. 1, the customer can use, consume, or sell the item either alone or together with other resources readily available to the customer. And 2, the good or service can be separately identified from other promises in the contract. The transaction price is the amount that ultimately will be recognized as revenue. The transaction price can be a fixed amount, or it can include variable considerations such as discounts, rebates, price concessions, incentives, penalties, etc. The consideration may be stated in cash, or it may include non-cash items such as shares of stock. If variable or non-cash consideration is involved, significant judgment will be needed to estimate the transaction price. Variable consideration depends on the occurrence of a future event, such as a performance bonus that depends on meeting deadlines. You are permitted to include your best estimate of the variable consideration to which you will be entitled in the transaction price. You do not have to wait for the uncertainty to resolve before starting to recognize it. That could result in recognizing revenue earlier than under prior guidance if you had a practice of waiting for uncertainty to resolve before recognizing certain items. When deciding how much variable consideration to include in the transaction price, however, you are limited to an amount that is not probable of resulting in a significant reversal of revenue when the future event occurs and that amount becomes known. That is, you can't recognize an amount today knowing that you'll probably have to reverse it tomorrow. Non-cash consideration should be included in the transaction price at fair value. The transaction price also should be adjusted for some other items. For example, collections on behalf of third parties, such as sales taxes, should be excluded. In other words, revenue should generally be recognized net. Consideration payable to a customer, such as a coupon or sales incentive that is more than the fair value of any goods or services received from the customer, also should be deducted. The transaction price should be adjusted for the time value of money if there's more than 1 year between delivery and payment. Now for step 4. You earn revenue when you satisfy a performance obligation. That is, when customer gets control of the goods or services that make up the performance obligation. Accordingly, you need to determine the appropriate amount of revenue to recognize for each performance obligation. Therefore, after you determine the transaction price for a contract, you need to allocate the transaction price to various performance obligations that make up the contract. The goal of dividing the transaction price is to identify the amount a contract entitles you to in exchange for satisfying each performance obligation. If a contract has only one performance obligation, the entire transaction price can be attributed to that performance obligation. But if there are 2 or more performance obligations, you have to allocate the transaction price to the performance obligations. That involves doing the following: determining the standalone selling prices of the goods or services, adding up the standalone selling prices of the goods and services that make up each performance obligation, calculating allocation ratios based on the totals of the standalone selling prices for each performance obligation, allocating the transaction price. Now, to determine a standalone selling price, it's preferable to use observable prices or estimates using an approach that maximizes observable inputs, such as adjusted market assessment, expected costs plus margin, or a residual approach. And you also need to consider any discounts or variable consideration. Sometimes those might apply to a specific performance obligation, and other times they also will need to be allocated. The amount of the transaction price allocated to a specific performance obligation is recognized as revenue when or as the performance obligation is satisfied. A performance obligation is satisfied when the customer gets control of the related goods or services. Control is the ability to direct the use and obtain substantially all the remaining benefits from an asset. Control can be transferred over time, which might be typical for a service or construction contract, or at a point of time, such as in a retail transaction. Revenue is recognized by measuring the progress towards satisfying the performance obligation. A method that best depicts the transfer of goods or services should be used, such as an output or input method. One example of an input method is the cost-to-cost method, which measures progress based on costs incurred to total expected costs to complete a performance obligation. If you're unable to reasonably measure progress, then you should recognize revenue only to the extent of costs incurred. Something equivalent to current completed contract method is not allowed under this new guidance. The timing of revenue recognition might be affected by under certain types of arrangements that can affect transfer of control. You'll need to consider the effect of things like bill and hold arrangements, consignments, obligations to accept returns or give refunds, repurchase agreements, and gift card breakage if you enter into transactions involving those features. There are also special rules for recognizing revenue for licenses of intellectual property. Now, as I previously mentioned, the current revenue guidance is much more rules-based versus the new guidance being more principles-based. The current guidance focuses on when revenue is earned and realizable. When those 2 criteria are met, revenue is recognized. The new guidance looks at 4 criteria: whether there is persuasive evidence that an arrangement or that an agreement exists; 2, whether delivery of the goods has occurred or the service has been rendered; 3, whether the price is fixed or determinable; and 4, whether collectability is reasonably assured. If all 4 of those criteria are not met, then revenue should not be recognized. Current GAAP also has a great deal of industry-specific guidance, such as for software, construction contractors, entertainment, agriculture, airlines, healthcare, and many more. The new guidance does not include industry-specific guidance, as the requirements were written in a way to address all industries. The disclosure requirements in the current GAAP are very limited, and more of the disclosures seem to involve accounting policy type matters. That is about to change, as the new revenue recognition guidance includes several required disclosures involving revenues. Some of the disclosures are optional for non-public entities, so we expect many non-public entities to not make those disclosures. However, if non-public entities elect not to make some of the optional disclosures, FASB has added other disclosures that non-public entities have to make in place of the primary disclosures. Those disclosures are generally less complex, but still there are new disclosures that will be required. For example, all entities are required to disclose some information about the breakdown of revenue based on whether controlled transfers over time or at a point in time, as well as qualitative information about how economic factors such as types of customers, geographical locations, and types of contracts affect the nature, amount, timing, and uncertainty of revenue and cash flows. In addition, you'll have to disclose several pieces of information about your performance obligations, such as the significant payment terms, obligations for returns, refunds, etc., and the amount of revenue recognized in the current year from performance obligations satisfied in a prior year. If revenue is recognized over time, it will be necessary to disclose the method used to measure progress and how it is applied. And if variable consideration is involved, information will be required about how it was estimated. Now, a public entity is defined in the FASB codification as a public business entity, a not-for-profit entity that is issued or is a conduit bond obligor for securities traded, listed, or quoted on an exchange or over-the-counter market, and an employee benefit plan that files or furnishes a financial statement to the SEC. Those are all considered public entities for the purpose of these effective dates, which will be for annual reporting periods beginning after December 15th, 2017, which means fiscal year ends of 12/31/18 and later. For non-public entities, the effective date is for annual periods beginning after 12/15/2018. So for most entities, that would be for fiscal year ends 12/31/2019. If you so choose, the early application dates are either for annual reporting periods beginning after 12/31/16, including any interim periods within that reporting period, or for annual reporting periods beginning after 12/31/16 and any interim periods within annual reporting periods beginning 1 year after the annual reporting period in which the guidance is first applied. I think it's unlikely that, that most entities are going to adopt to early apply the standard. Now, there are two implementation options available to you. If the full retrospective adoption is selected, the financial statements are presented as if the guidance had been applied to all contracts with customers presented in the financial statements since the inception of those contracts. For a non-public entity that presents the current year and the prior year comparative financial statements, the guidance would have to be applied at the beginning of the earlier year. There are, however, a few practical expedients that are permitted. For example, one practical expedient is not to restate completed contracts that begin and end in the same annual reporting period. Another is for contracts that include variable consideration. The actual rather than the estimated consideration can be used to determine the contract's transaction price in the comparative reporting periods. If the modified retrospective approach is selected, the guidance is applied as of the beginning of the current year and then to subsequent periods. The prior periods presented in the financial statements, if any, are not restated. You apply the guidance retroactively only to contracts that are not completed at the date of the initial application. Those contracts have to be evaluated as if the requirements had been applied since the inception of the contracts. The cumulative effect is then recognized as an adjustment to beginning retained earnings, net assets, or other appropriate component of net equity or net assets. However, it's important for you to note that if you select this approach, you're required to disclose the amount that each line item in the financial statements is affected in the current period by applying the new guidance rather than prior GAAP. Thus, you'll need to maintain your accounting records under both the old and new guidance during the initial year of adoption. So let's talk about how you begin to implement. As we've discussed, the new revenue recognition guidance may affect how and when you recognize revenue, how you measure the revenue, and how you disclose information about your revenue. However, some entities have found that it also requires changes in their operations, information technology systems, processes, and internal controls. For example, you may need to implement or modify procedures for how information and documentation will be gathered to make required estimates and judgments. Or you may need to make changes to your automated systems to estimate variable consideration or determine standalone selling prices. The level of effort that will be required to implement will vary by entity and especially by industry. Some industries will require only minimal efforts to implement the guidance, and others will need a significant amount of time and effort by multiple employees, including some management, for a successful implementation. There will likely be a more significant effect on entities that currently follow industry-specific guidance, such as software, real estate, asset management, wireless carriers, etc. Companies with longer contracts with more components and companies with significant variable consideration will also have more of an impact. For some entities, responsibility for implementation may be assigned to an individual, while other entities may assign responsibility to a cross-functional team. The person or group assigned responsibility will become your entity's expert on revenue and take the lead in the implementation process. It's also helpful to make sure that management and employees throughout most departments are aware of the new guidance and what is needed to implement it. Next, those responsible will need to carefully consider the entity's operations and financial statements to assess the potential effects of the implementation. They'll need to consider existing contracts and identify any contract features or terms that may require additional analysis, such as contracts that include both goods and services, to identify the separate performance obligations. It's also important to identify the key estimates and judgments that are going to need to be made. Selecting the transition method is important, as that drives how far back information has to be gathered and assessed. It may be necessary to make changes to your operations, IT systems, processes, and internal controls, so it is important to identify those needed changes as early as possible to allow time for revisions to be made and adequately tested. At some point before implementation, it will be necessary to train staff that will be involved and those whose job responsibilities will change. Finally, it's important to discuss the expected changes to your financial statements with those who use the financial statements and your stakeholders. Now, I want to talk a little bit about an implementation tool that we've developed here at Sikich. We've recently developed a comprehensive tool here at Sikich to help you implement the new revenue recognition standard. So now you can assess the impact on your financial statements and operations with help from your Sikich engagement team. They are ready to meet with and work through the tool with you to inform you of all the information necessary to best assess your financial situation. The tool itself is modeled after the 5-step approach we just discussed. For each step, there's a list of questions and actions based on answers to those questions. For example, we go to step 1. Step 1 has a list of 10 questions and actions based on answers to those questions. Step 3, determining the transaction price, which is generally more complex, has up to 43 questions. You can see here, we go down the tool here, 43 questions and actions to take. Also for each step, there is an impact table. You can see here, go up here. An impact table where concepts and issues in the new guidance can be identified to determine if they will affect the measurement, timing, and disclosure of revenue. The information gathered in that table will better assist you in answering the questions in the decision processes. You may notice in those impact tables that we have a reference to a particular section of a research manual that we've been using. This manual is the PPC Revenue Recognition guidance published by Thomson Reuters. The references we provided point you to sections in that manual that define and illustrate the concepts and issues in the impact table. Your Sikich engagement team will be happy to lend you a copy of the manual while we are working with you on the implementation. Due to copyright restrictions, though, we cannot outright give you the manual based on a subscription agreement with Thomson Reuters. However, we have been able to negotiate a 15% discount for you off the base price of $400 for the revenue recognition manual if you'd like to own your own copy. We believe that most of you would find such a manual such as this easier to follow than the actual FASB codification. The PPC manual still does include references to the specific sections of the FASB codification. This is important because ultimately the codification is the authorized source. But still, the PPC manual is very nicely organized and has many excellent examples which to help you learn the revenue recognition guidance and compare to your specific facts and circumstances. For those of you participating in this webinar who are not Sikich clients, we'd be happy to schedule a consultation with you to discuss how the revenue guidance may impact your organization. During that consultation, we'll provide you with our tool to help you through the implementation process. However, we highly recommend that you use the tool in conjunction with a consultation from us, as was the design intent. The tool is about 25 pages long and is not all-inclusive of every possible fact and circumstance that could impact your revenue streams. For that reason, we recommend you consult with us on your implementation guidance and implementation issues. Other noteworthy things that the tool has include detailed instructions, an overall flow chart of the revenue recognition guidance, as you can see right here, a page to capture all the relevant terms and conditions of particular revenue contracts, a write-up box to describe the results of the analysis, a table to list out all the performance obligations found in Step 2, calculation tables for Step 3 and 4, and additional appendices to address other important decisions and concepts that may be relevant to the revenue recognition criteria, such as modifications and principal versus agent considerations. The most important thing you can probably do at this time, other than to meet with us to discuss your implementation, is to start identifying and gathering all the contracts and revenue streams that will be necessary for us to help you with your analysis. We will need all the documentation that covers the parties, terms and conditions of these contracts. If you have hundreds of customers covered by exactly the same type of contract, then we don't need each contract for every customer. However, differences in the negotiated terms of the contract, such as discounts, incentive, rebates, and other variable consideration, could give rise to different measurement and timing amounts. Therefore, some sorting of contract into different buckets may be necessary. Again, we are happy to provide you with assistance with the analysis, but we'll need you to provide us with all the information necessary for us to do a complete and thorough analysis. It's very possible that you will use multiple copies of our tool to document the accounting issues for the different types of contracts that you have. Again, please reach out to your client service representative for more information concerning our tool and your implementation. We're here to help you and look forward to talking to you. I hope this introduction to the new revenue recognition guidance has provided you with a good overview of the new requirements. I thank you for joining us today, and we value our relationship with you and are thrilled you took the time out of your busy schedules to listen.